Hey everyone, and welcome. Today we are diving into something that is absolutely crucial, but honestly often gets missed by property buyers in India. We're talking about TDS, or tax deducted at source. If you're even thinking about buying a property, you are going to want to stick around for this.
So let me just ask you straight up. Are you in the market for a new home? Maybe a piece of land? Basically any property that's valued over 50 lakh rupees? If you're nodding your head yes, then believe me, this explainer is made for you.
Because you might not know this yet, the second that property deal crosses that 50 lakh mark, the law gives you a brand new job. And no, this isn't optional. It's a legal duty that lands squarely on your shoulders as the buyer.
All right, so here's our game plan. We're going to uncover what this hidden duty is all about. We'll decode the actual law so you know the rules. Then we'll walk step by step through the filing process. We'll cover the final, crucial piece of paperwork, talk about the serious costs of getting it wrong, and wrap up with some tricky special cases. Let's get you from confused to confident. So what exactly is this hidden duty? Well, think of it this way. The government has basically drafted you. When you make a high-value purchase like this, you become a vital cog in their machine for tracking big-ticket transactions. It's all about making sure the seller's tax obligations are on the radar from day one. You're not just a buyer anymore. You're kind of an agent for tax compliance. So where does this all come from? Well, this whole responsibility is spelled out in one specific place, Section 194IA of the Income Tax Act. You can think of this as the official rule book for this new role you've just been given. And rule number one, the big one, is the trigger point. Your TDS duty kicks in if the sale price you agree on or the property's official stamp duty value hits 50 lakh rupees or more. It just takes one of those numbers to cross the line and bam, you're in the game. So, what do you actually have to do? Simple. You have to deduct tax at a flat rate of 1%. Now, here's the part that trips a lot of people up. That 1% is on the entire sale value, not just the bit over 50 lakh. So if the property is, say, 70 lakh, you deduct 1% of the whole 70 lakh. Super important to remember that. And total value has a wider meaning now. Since 2019, it's not just the sticker price of the property. You have to factor in all those extras. The club membership fee, the car parking spot, advanced maintenance, the whole shebang. So you've got to get a full cost breakdown from the seller to make sure your calculation is spot on. Okay, theory is great, but how do you actually get this done? Let's get into the practical side. The main tool you're going to use is an online form called, get this, Form 26QB. This single form is how you report the transaction and pay the tax to the government. First things first, you need to head to the official income tax portal. That's incometax.gov.in. Be careful and make sure you're on the real government site. From there, you'll find the ePay tax service. Click New Payment, and then look for the option that says 26QB. The first part is pretty easy. You just enter your details and the seller's details. Double and triple check those PAN numbers. Getting them right is absolutely critical. All right, next up, you'll punch in the property's address and the two magic numbers, the sale consideration and the stamp duty value. And here's some good news. The system is smart. It will automatically figure out which of those two is higher and calculate the 1% TDS for you. Then you just pick your payment method, finish the transaction, and this is key, save that final challan receipt. That's your golden proof of payment. Let's look at a real-world example to make this crystal clear. So Mr. Verma is buying from Mrs. Singh. You can see the stamp duty value is 92 lakh, which is higher than the sale price. So we start there. Then we add in those 3 lakhs of extra charges. That gives us a total base of 95 lakh for the TDS calculation. 1% of that is 95,000 rupees. That's the amount Mr. Verma has to deduct from his payment to Mrs. Singh and deposit to the government. Simple as that. Okay, so you've paid the 95,000 rupees. You're done, right? Time to relax? Not quite. There is one more incredibly important step you cannot forget. You have to issue a TDS certificate to the seller, and it's called Form 16B. So what is this form? Think of it as the seller's receipt. It's the official document that proves you've paid the tax on their behalf, and it's what they need to claim that tax credit later. And you're on the clock. You are legally required to give this to them within 15 days of the deadline for depositing the tax. Now, you don't find this form where you made the payment. You have to go to a totally different government website called Traces. You'll need to register there as a taxpayer, log in, and then you can request the form using the details from your 26QB payment. It usually takes a few hours, but once it's ready, you can download the PDF and send it straight to the seller. And this is where you can see the whole system come together. It's like a three-part check. First, you file Form 26QB. Second, that payment shows up in the seller's annual tax statement, which is called Form 26AS. And third, the Form 16B you give them is the physical proof they use to claim their credit. It's a perfect loop, and you, the buyer, are the one who kicks the whole thing off. So what if you forget a step? Or maybe you're just late? This is where things can get expensive, fast. The law has very specific penalties for getting this wrong, and they are not kidding around. Just look at this breakdown. Every mistake has a price tag. If you're late to even deduct the tax, that's 1% interest per month. If you deduct it but then you're late to pay the government, that interest rate jumps to 1.5% per month. And on top of all that, there's a painful late fee of 200 rupees for every single day you're late filing that Form 26QB. In serious cases, penalties can go all the way up to a lakh. This is definitely not a place you want to be sloppy. Now, we all know property deals can get complicated. So let's quickly cover a couple of the most common tricky situations. What happens when your seller is an NRI, or when multiple people are buying or selling together? Pay close attention here because this is huge. If your seller is a non-resident Indian, an NRI, then everything we just talked about, you can just throw it out the window. It doesn't apply. The deal falls under a completely different law, Section 195. And as you can see, the rules are night and day. The TDS rate skyrockets to 20 or even 30%. There is no 50 lakh minimum. And you, the buyer, have to get a special tax deduction account number, or a TAN. The forms are different, the rules are different. Making this mistake is a really big deal. And what about multiple buyers or sellers? The rule is actually pretty logical. You have to file a separate Form 26QB for each unique buyer-seller pair, splitting the property value between them. So, if there are 2 buyers and 1 seller, that's 2 forms. If there are 2 buyers and 2 sellers, you guessed it, you're filing 4 separate forms. It's a lot of paperwork, but it has to be done. And what if your seller just says, sorry, I don't have a PAN card? Well, the law has an answer for that. The duty to deduct tax is still yours, but the rate jumps from a friendly 1% all the way up to a penal rate of 20%. So yeah, getting that seller's PAN is something you want to sort out right at the very beginning. So let's leave it with this thought. You've signed the deed, you've got the keys, the celebration is starting. But always ask yourself this one last question. Is my tax duty complete? Because as the buyer, your responsibility goes beyond just the payment. Seeing that TDS process through to the very end, that's what makes a property transaction truly and fully complete.